Hi, this is Larry Hansens with the H Group Incorporated. Well, what a wild quarter we just came through. You could say it came in like a bear and went out like a bull. To say the first trading day of the quarter was bad would be to understate the entire week. During that first week of the year, the Dow Jones Industrial Average was off 1,100 points or 6.2%. This was the Dow's worst start to any year ever. We heard that interest rates are rising, China is slowing, the price of oil was nearing a 13-year low, and Japan had just pushed borrowing costs to negative territory. By February 11th, all of the major US indices were down over 10%, which is the definition of a market correction. When we look back into 2015, we saw that the Dow Jones was down almost 15% from its May 2015 high. The S&P 500 was down 14%, and the NASDAQ was down 18%. Many investors were becoming increasingly nervous, and many of the bears out there were saying, see, we told you so. Then everything seemed to change. The Fed came out and said they would be paying attention to what's happening overseas when deciding future interest rate hikes in the US, and that there would likely be a lower number of hikes in 2016 than they had originally broadcast. Originally, they were looking at doing maybe 4 interest rate hikes, and now we're looking at maybe 2. The European Central Bank came out and took some additional stimulus measures. China began taking steps to steady their economy, and a bunch of decent economic data in the US helped to ease fears of a recession, and the rally started. Today we're looking at slightly positive year-to-date numbers for the Dow and the S&P, slightly negative numbers for the NASDAQ. Generally speaking, we are seeing growth in the US, albeit slow growth, but still growth. Based on the latest release of the Conference Board's leading economic index, the growth rate has moderated in recent months, but the outlook remains positive. For those of you who have been with us a while, what I'm about to say should be no surprise. Volatility happens. Shorter term money should be invested in shorter term investments. Longer term money should be in longer term investments. In the short term, we can't tell you whether the markets are going to be up and down, but generally speaking, in the long term, they tend to trend upwards. Sit tight, stay calm, and happy investing.